Welcome to Voice Daily Finance, the most important news personalized for you every day. Supported by Voice.com.
After listening to today's news, you'll know first, UK's G7 highest industrial energy prices spark deindustrialization fears, complicating the Bank of England's rate decisions. We'll explore how this structural energy crisis complicates the BOE's inflation fight and impacts the pound's long-term trajectory. Second, 251 billion euros in trade makes China Germany's top partner as its auto industry splits from the EU's derisking strategy. Today, we'll take a closer look at the conflict between German industrial interests and EU policy and its implications for transatlantic trade relations. Third, amid a $10 oil risk premium, Iran offers the US investment access in a potential deal designed to challenge China's influence. In this episode, we'll break down this surprising offer and what it signals for global oil markets and US-China competition. The United Kingdom now has the most expensive industrial energy prices among all G7 nations. That's not just a headline, it's a crisis unfolding in real time. According to a new report from the Confederation of British Industry and Energy UK, a staggering 40% of businesses are now cutting back on investment directly because of soaring energy costs. Almost 90% of all firms have seen their energy bills rise. Let's look at the numbers. Business electricity costs remain 70% higher than before the war in Ukraine, with gas prices up 60%. And this isn't just a small increase. Research from the Institute of Economic Affairs shows that UK industrial electricity prices are now the highest among 28 developed countries. To put that in perspective, UK prices are roughly 4 times higher than in the United States and 46% above the median for all countries surveyed. That is a massive competitive disadvantage. For medium-sized businesses, UK electricity prices are now around double the median across the European Union, leading industry leaders to issue their most severe warning yet. The UK is in danger of widespread deindustrialization. The fallout is already hitting the books. Britain just reported its worst trading goods performance on record, with the deficit ballooning to over £248 billion. Now, this isn't just an accounting figure. A persistent and large trade deficit like this creates a structural headwind for the country's currency, the British pound. The consequence is that the UK has to constantly attract foreign capital to fund this gap, making the pound more vulnerable to shocks in the global financial markets. The CBI's chief economist says the damage is not theoretical, stating you can see it already in the chemicals industry, which has seen several closures. In response to government support measures, the head of Energy UK called the help a sticking plaster that is simply being funded by other bill payers, and he's pointing to a very real economic dilemma. For example, the government's British Industry Supercharger program gives hundreds of energy-intensive businesses exemptions from various green levies, but where does that money come from? The cost is effectively spread across the bills of all other businesses and household consumers. Essentially, this can create a subsidy inflation trap. While it helps a few large industries, it keeps costs high for the much larger services sector. This complicates the Bank of England's fight against inflation and could force it to keep interest rates higher for longer. Industry groups argue that the high costs are a major brake on economic growth, preventing companies from investing in the transition to clean energy, even when they know the long-term benefits. And the numbers back this up. It's a classic case of crowding out where urgent operational costs push aside important long-term investment. What's striking is that while this is happening, the US and EU are experiencing subsidy-driven booms in green investment. The UK isn't just stalling, it's actively falling behind in the race for future green industries. Data shows that after peaking in 2022, private investment in UK green and clean tech businesses has plummeted, falling by 44% in 2024 to its lowest level in years. A task force is now demanding a fundamental review of the UK's entire energy market and its regulations. This brings us to the real heart of the problem. Many experts believe the core issue is regulatory paralysis. Uncertainty over how and when the UK will reform its outmoded energy market rules is the single biggest thing deterring the massive private investment needed to modernise the grid. This policy in action traps the UK in a high-cost, low-resilience energy system. The core warning from their report, however, is stark. Without a major reduction in energy bills, the risk of job losses, production cuts, plant closures and offshoring will only increase. So what's next? In the short term, this structural problem will continue to weigh on the British pound and complicate the Bank of England's decisions on interest rates. For investors, UK industrial stocks may underperform compared to their international peers. The key thing to watch for is any real concrete action from the government on overhauling energy market regulations. Until that happens, these high costs and the threat of deindustrialization will remain a major headwind for the UK economy. While the UK is grappling with internal economic headwinds, another European giant, Germany, is making strategic moves that are sending ripples across the continent. For the first time, China has officially overtaken the United States as Germany's number one trading partner. A while back, we flagged the surge in Chinese imports as the main trend to watch. The latest development is that it has now tipped the overall ranking for Germany. Now get this, this isn't just a random fluctuation. There are strong arguments that this shift is partly an unintended consequence of recent US economic policy. Policies like the Inflation Reduction Act, while designed to boost American industry, have created trade friction with European allies, potentially pushing a manufacturing powerhouse like Germany to look elsewhere. This marks a major reversal from just last year, when the US was still Germany's top partner with bilateral trade totaling over 253 billion euros. The new figures are staggering, 251 billion euros in bilateral trade, but the real story is the imbalance. Germany is now importing goods from China worth over 170 billion euros, while only exporting 81 billion euros back. That's more than a 2-to-1 deficit, and it reveals a deep dependency. A while back, we also noted how a flood of cheaper imports can be disinflationary in Europe. This widening gap puts that pressure squarely on the European Central Bank's radar, even as other risks pull the other way. The dependency, interestingly enough, goes far beyond finished consumer goods. The core of the issue is Germany's reliance on Chinese industrial inputs, the essential components needed for its own manufacturing. We're talking about critical parts for the automotive and electronics industries. In fact, one study identified 85 different product groups in the chemical sector alone where Germany has a high import dependency on China. We previously highlighted this duality, short-term price relief versus long-term strategic vulnerability, and it's now concentrated right at the heart of Europe's industrial core, exposing it to potential supply shocks. This all comes as the German Chancellor makes his first official visit to Beijing, and the core conflict is now out in the open. He's expected to raise trade, human rights, and the war in Ukraine. While the European Union struggles to limit China's influence with tariffs and talks of derisking, Germany appears to be breaking ranks. A few days ago, we talked about Brussels pushing a harder line. Today, Berlin's outreach suggests a different calibration. And the implications are huge. When a major economy like Germany pursues its own path, it weakens the entire EU's collective bargaining power. The bloc's derisking strategy relies on a united front to be effective. Germany's divergence could not only undermine the EU's leverage in negotiations with China, but also spark internal trade disputes within Europe itself. We've said before, this is the policy crossfire, lower inflation from imports versus protecting strategic industries. But that's not the whole picture. The real turning point is that this split is being driven by Germany's most powerful industry, its car manufacturers. Volkswagen has called China a second home market. BMW and Mercedes-Benz are heavily reliant on Chinese sales for their own success, and the scale of the investment is what makes this so critical. For example, BMW now considers China its second largest research and development location after Germany, and just recently signed a massive 2.5 billion euro agreement to upgrade its production facility in Shenyang. When the EU moved to introduce tariffs on Chinese electric vehicles, Germany voted against the measure. As we discussed a while back, those duties were set to go as high as 38% on certain models. Germany even secured a special exemption for a Chinese-built Volkswagen SUV from those same EU tariffs. Here's where it gets interesting. It points to a boomerang effect that's happening in the industry. After years of offshoring production to China to cut costs, German car brands are now starting to import those Chinese-made cars back into Europe to sell them here. This means Germany's own industrial champions are effectively lobbying against the EU's protective trade measures because those tariffs would hit their own products. It's a complex situation that risks hollowing out domestic manufacturing value in the long run. The CEO of BMW, who is accompanying the Chancellor on the trip, sent a clear message stating that complex global challenges can only be solved by working together. This isn't just a trade report, it's a map of a new economic reality. While Brussels and Washington strategize to counter China's dominance, the actions of Europe's largest economy signal a starkly different path. Germany's economic interests, anchored by its auto giants, are forcing it to deepen ties with Beijing, creating a fundamental fracture in the Western alliance's economic front. We previously analysed how this could intensify a tug-of-war for the ECB disinflation from imports on one side, industry protection and geopolitical shocks on the other. So what's next? In the short term, this deepening trade relationship could put downward pressure on the euro relative to the yuan. And as we noted a while back, if these deflationary imports persist, the ECB could be nudged to ease faster than the Federal Reserve, adding euro-dollar volatility to the mix. For investors, German auto stocks might see a boost from their strong position in the Chinese market, but this comes with significant long-term geopolitical risk. The key focal point to watch now will be the European Commission's response. Will Brussels try to rein Germany in, or will other EU nations with strong industrial ties to China begin to follow Germany's lead? As with all market data, this information is for informational purposes only and is not investment advice. Market conditions are volatile and can change rapidly. Speaking of fractures in global alliances, the geopolitical chessboard is getting another major shake-up, this time in the Middle East. Fears of a military confrontation are growing as the US considers limited strikes against Iran. But while military forces are on high alert, a tense negotiation is playing out behind the scenes. A senior Iranian official told Reuters that Iran and the United States have fundamentally different views on sanctions relief, with new talks scheduled for early March. So the thing is, this tension is already being priced into the global economy. Economists call this the geopolitical risk premium on oil. It's the extra amount we all pay for a barrel of oil because of the fear times of a potential supply disruption. Right now, Goldman Sachs estimates this premium is around $10 per barrel. This premium, in effect, acts as a headwind for energy importing economies and pushes up global inflation forecasts. Believe it or not, the risk isn't just about oil prices. The Strait of Hormuz, which Iran has threatened in the past, is a critical choke point. About 21% of all the world's daily petroleum consumption passes through it. So even without a direct conflict, just the heightened military posturing can cause war risk insurance premiums for shipping to skyrocket. This creates separate supply chain bottlenecks and inflationary pressures that have nothing to do with the price of crude oil itself. The economic consequences begin long before any shots are fired. At the heart of the standoff is Iran's nuclear program. Washington has demanded Iran relinquish its stockpile of highly enriched uranium. According to the UN Nuclear Agency, that stockpile is estimated at more than 440 kilograms of uranium enriched to 60% purity, just a small step away from the 90% that is considered weapons grade. And to give you a sense of how alarming this number is, the latest reports from the International Atomic Energy Agency, or IAEA, confirm this figure represents a significant recent increase. This is crucial because the IAEA has expressed serious concern, pointing out that Iran is the only non-nuclear weapon state in the world to be producing uranium enriched to such a high level. This fact dramatically raises the stakes in these negotiations. However, if you zoom out, you'll see another layer of strategy at play. Despite rejecting a US demand for zero enrichment, Tehran is signaling a potential compromise. The Iranian official said Tehran could seriously consider exporting part of its stockpile in exchange for the recognition of its right to peaceful nuclear enrichment, stating that the possibility of an interim agreement exists. This is where the situation takes a more complex turn. In a stunning reveal, the official stated that as part of a potential deal, the United States has been offered opportunities for serious investment and tangible economic interests in Iran's oil industry. The official clarified that American companies could participate as contractors, but Tehran would maintain control over its resources. This is a bombshell, and not just for Washington. The timing of this offer is likely no accident. It appears designed to directly challenge China's energy strategy in the region. For years, China's independent or teapot refineries have been major buyers of sanctioned Iranian oil, often at a discount. If American firms are suddenly allowed to invest and compete for those same barrels, it recalibrates the entire geopolitical landscape. It would force China to compete directly with a new Western presence, testing Beijing's influence in a key partner nation. This creates a volatile and unpredictable landscape for global markets. On one side, the threat of military action that could disrupt global energy supplies. On the other, the potential for a landmark agreement that could see American companies investing in Iran's oil and gas fields for the first time in decades. So what happens next? The crucial point is that markets will not wait for a final agreement. We are already seeing what analysts call front-running. The mere possibility of a deal could spark a rally in the Iranian rial and its stock market in Tehran. For us, These local markets will act as a real-time sentiment gauge on how the negotiations are truly progressing. The outcome of these high-stakes talks will have major repercussions. Moving forward, the key focal points to watch are the conflicting diplomatic statements, which signal the real probability of a deal, the level of that oil risk premium we discussed, and any naval deployments in the Persian Gulf. These are the leading indicators that will tell us where this story is headed. This information is for informational purposes only and does not constitute investment advice. Market conditions are highly volatile.
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.